Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing pretty good. How about you?
Good, thank you. We've got a good show today. We're going to be talking about retirement pitfalls. Okay, these are some of the questions, concerns that we see retirees go through. In our office, we've experienced quite a few of these things as retirees talk about the next stage of retirement, which is the planning. So what we're going to talk about is retirement pitfalls, and we're going to start out with number one that we see in our office when people come in. It's investing too conservatively. And what happens here is people are preparing on their own for retirement. They think that they need to get ultra conservative with all of their investments, and unfortunately, they don't keep up with certain things like inflation. So we're going to talk about investing too conservatively. Ty, what do you have to say about that?
Yeah, Dean, and this one may come as a surprise to some people with it being investing too conservatively as a pitfall. But typically we see many retirees as they head into retirement, they don't want to take a lot of risk in the stock market, so they get pretty conservative, and so much so that it actually hinders them in their long-term plan, because many retirees fear that they fear the stock market so much so that they keep a substantial amount of their retirement funds in safe investments like checking, savings, money market accounts, CDs, and fixed annuities, different types of safe fixed investments. And one major mistake you make by taking that approach is inflation. And inflation can erode retirement funds over time if they're too safe and not making enough return over time. So, for example, let's say you have $200,000 in a CD that's averaging, let's say, 1% per year in interest, and at the same time, you're also withdrawing money from that account to supplement your Social Security or your pension in retirement. You're probably going to outlive your money over 20, 30, 40 years in retirement if you continue on that route. So ultimately, with such low interest rates that we have currently, inflation can eat away at retirement savings. So then the next question becomes, how do we fix that? What can we do to combat inflation? And our number one answer is to diversify. So you want to spread your retirement funds among different types of stocks, bonds, mutual funds, exchange-traded funds, CDs, fixed annuities, and a number of different assets that way. And if you're conservative, maybe you have 80% of your retirement funds in bond positions or fixed annuities or CDs, and yet you still have 20% in stock positions. That might be individual stocks or stock mutual funds or ETFs or index funds that can produce enough growth potential to combat inflation over time. And keep in mind, diversification, it doesn't guarantee a profit or protect against loss. It's a method used to help manage investment risk. Okay, and adding to that, as a population, we're also living longer, so it's that much more important to make sure that you look at diversification. You look at covering the first stage, the second stage, and the third stage of your retirement. Too conservative, you're not going to keep up with inflation. Also understand, we're not saying that you shouldn't have money in safe areas. That's not it at all. You just want to make sure that you meet with somebody who can explain how much you should have in the safe areas or fixed income areas, the income and the growth areas, because we believe that the basic foundation for all investment portfolios for retirees starts out with safety first, and then you go on to income and growth. So the first pitfall was investing too conservatively. I'm sure you can figure out what the second pitfall is, and that is becoming too aggressive. Tyler, let's take our listeners through this one. Yeah, the second retirement pitfall is, as you mentioned, Dean, the opposite of the first one. It's actually investing too aggressively. And we see people who fear they've started investing for retirement too late in life. So they choose to invest 100% of their investments in high risk places, which can lead to big losses if they're not managed correctly. And The main reason why people do this is to catch up, as we call it, because they may not have started saving for retirement like they should have in their early years. So instead, they decide to take on more investment risk heading into retirement in order to generate more wealth. So instead of constructing a balanced portfolio, trying to average 5, 6, 7, 8% over retirement over their lifespan into retirement, they may go into an all-risk, all-stock portfolio trying to chase a 10, 11, 12%. And with that philosophy, many people either strike out or they can hit a home run, depending on the market. But all in all, it's a pretty dangerous game for a retiree to play heading into retirement, trying to invest in all risk to try and get higher return. So instead, what we recommend is to sit down with an advisor and find out what your true investment risk tolerance is, so that way you have a portfolio that can better suit your needs. So what we do in our office is we have what's called a risk profile questionnaire. It's a questionnaire that clients fill out, and that helps determine what their true risk tolerance is. And some people, they see the market doing well and they want to be 100% invested in stocks, but they don't want to take on 100% of the downside that stocks have when the market sours and has a downturn. So it really all comes down to constructing the right portfolio based on your individual needs and risk tolerance, which for most retirees will be a balanced portfolio containing a number of different investment types. Just like we mentioned in retirement pitfall number 1, you want to diversify and have different assets.
Okay, and also as you start getting into your 50s, that's when you start really looking at the possibility of scrutinizing your investment portfolios to prepare them for retirement. So what you're doing is you're aging into those retirement years. Your portfolio should age and change with you. As far as investing too aggressively, one thing we see here too is some people, whether they're investing on their own, somebody else will come in from a different advisory firm, and it looks like they're chasing gains. And that's a dangerous thing to do, is when you start chasing gains, because if you look historically at the market, you will see different sectors and you'll see different indices performing well one year and maybe not the following year. So part of that investing too aggressively has to do with chasing gains. It also has to do with the possibility of overweighing certain sectors. Right now, you know, the tech sector has been on a wonderful run here, and you will see some people gravitating most of their investments as they get older into those sectors that are performing very well, and they have no hedge should that sector start to sour. So again, diversification is key. Don't want to get too aggressive. You want to make sure that you have a hedge in your portfolio so you can fall back if certain sectors go out of favor.
Yeah, and Dean, I just wanted to add one more thing there in investing too aggressively. When you ask many people if the market goes up 10%, they would be okay with getting 6, 7, 8%, but if the market goes down 10%, usually they don't want to lose any more than 2 or 3%. So if they have an all-aggressive portfolio, it's important that they realize that if the market does go down 10%, they're probably going to be going down right with the market. So it's all about, again, just reiterating that we want to find your true risk tolerance.
Good point. Okay, the next one is supporting your adult children. Okay, we see this one a lot. I think it's fair to say that most of us, all of us, love our children. We want the best for them. But enabling children when they're perfectly able to go out and work and start putting their own funds away and paying down their own bills is probably the wrong thing to do. Especially if you are fully in retirement. Remember, you no longer have payroll coming in. So if you have retirement accounts and investments that you pull a lump sum of money out to give to a child for a down payment or college education, chances are you will not replace that money. Again, you have no more payroll coming in. So that money is really scheduled to grow on its own. And it's also scheduled to pay you over your lifetime once you do retire. So if you take that money out as a lump sum, help your children with a down payment or a college education, again, it probably will not be replaced anytime soon, or actually in your lifetime at that point. So what you need to do is, when it comes to your child, is work with them, make sure they understand the expense side of purchasing. The other thing too is there's a couple of rules of thumb. This is not a certainty, but it's a rule of thumb. When it comes down to college funding, you want to meet with your child or your grandchild and let them know that whatever profession they plan on going into, the rule of thumb is your starting salary that first year you get out of college should be no more than the amount of expense you incur for your college education. So if you think you're going into a profession that's going to pay $50,000 a year, rule of thumb is you shouldn't go more than $50,000 in debt for a college education. And to add a little bit more onto this conversation, if as a retiree you are not financially fit, how can you possibly help your children financially in the future? Actually, you're going to probably become a burden to them. So I think I beat this one up enough supporting your adult children. Am I missing anything, Tyler?
Yeah, Dean, again, just that it's very hard to support your adult children while heading into retirement. And we've seen a few situations where there's people who are heading into retirement and they co-signed on student loans for their children in college, and here the children racked up a number of debt through those loans, and they may not even be going down that career path. They may not get a job. So now at that point, not only are the parents stuck supporting them, they're providing food, letting them live at their place, but some are also stuck paying down their children's debt, which can be hundreds of thousands of dollars in school loans. So again, supporting your adult children can be a retirement pitfall.
Okay, and one other item on that, too. You just got me thinking about something else, and that is the debt that you incur as a college student. If you come out of college and have $40,000, $50,000, $60,000 or more in student debt, be responsible. Go out and get a term life insurance policy on you. You are young at that time, provided you're in good health. It's dirt cheap. When you get your first job, get a term policy on you so nobody else is going to be burdened with having to pay off that school loan, because for those of you who don't know, it's very hard to get out from underneath a school loan. If you co-sign and you're responsible for it, even bankruptcy is not going to take you out from underneath it. Okay, let's go on to the next one here. Number 4, we see this, and that's being overinvested in your house. For those people who are working, they're in their 50s, even come into their 60s, they're getting ready to retire, they have put 40 to 50% of their income into their house over the last 10 or 15 years. They want to make it their retirement home. They do updating. They put additions onto it, whatever it may be. But at the expense of putting money into investments or retirement plans, they are overinvested in their house. And I will talk to people about this, and they'll say, well, if we need to, we can downsize. We can sell our house. Well, first of all, a house many times, depending on the market and prices, could be illiquid, meaning you will have a hard time selling it and getting out of it what you put into it. So be smart with putting the amount of money into the house that is over the norm. The other thing, too, is some people will say with the retirement planning, we put together financial plans complimentary for everybody who comes through our door to talk to us. And we talk about their house and a mortgage. And when it comes to their house, some people will say, well, I will just sell the house and downsize, or I'll sell the house and I'll use that money to live off of. And the first thing I'll ask them is, where are you going to live then? I mean, if you sell your home for $200,000 and want to downsize, that's fine. But if you sell your home and think you are going to rent for $200,000 over your lifetime, you might be hard pressed. Okay, go out there and look at what rental properties are costing at this point. So many times having an affordable mortgage going into your retirement is probably your best option, other than not having a mortgage at all. Tyler, am I missing anything here?
Good points there, Dean. But for those people who are pre-retirees, they haven't retired yet, but retirement may be on the horizon in 5 or 10 years or so, you want to keep in mind that you don't want to put all of your income into your dream retirement home without first making sure your retirement funds are adequate enough. So you can still look to add onto your home and maybe buy your dream retirement home, but you also want to make sure first and foremost that you have enough in retirement funds, because if you don't, then you may need to work longer and you can't enjoy it for as long a time, just because at that point you're going to have to work maybe an extra 10, 15, even 20 years to build up those retirement funds so you can enjoy your retirement lifestyle living in your dream retirement home.
Okay, one last thing about over-investing in your house. You hear some of these stories where people will refinance or they'll tap into a home equity line of credit to invest. So they feel that they haven't put enough money away for retirement. They overinvested in their house, so they'll refinance or take money out of their home equity line of credit to invest. Wrong thing to do. Okay, if the market goes down, you still have to make those payments. So don't get into a habit of doing something like that. Okay, the next item we're going to talk about is worrying more about taxes than return on your investments. There are some people that are so tax adverse that they really don't make wise decisions with their investment when it comes to their rates of return and so on. As an example, somebody came through our door a couple months ago. We saw this. They had a non-qualified investment portfolio with another firm, and I see that they had some positions that were out of favor in the market, and they were down $3,000, $4,000, $5,000 to their cost basis. And I asked if their advisor had made a recommendation to move out of those positions and into something that was better suited in their portfolio. And they said, sure, but that would result in a couple $100 of taxes that we'd have to pay, so I don't want to do that. Now, let me get this straight. A couple $100 in taxes versus down $4,000, $5,000, or $6,000 in the portfolio when you can move out of that position doesn't make sense to me. I don't want to pay taxes. I don't want any of our clients to pay more taxes than they have to. But at times you have to make the right decisions, and that is, look at the return on your investment, make wise decisions in your investment versus watching that particular tax situation. Another one we see is we'll have clients come in and they might have a portfolio that has a lot of tax-free bonds at that particular time. They have heard that you can get double and sometimes triple tax-free exemptions on bonds. They like that idea. They don't have to pay taxes. Well, first of all, many times the returns are extremely low. And I'll also ask them, well, what tax bracket are you in? Well, I don't really know. So we'll talk about it, find out that they're in a low tax bracket. So really, are they getting a complete advantage by being in tax-free bonds? Probably not. Tyler, anything else to add to this?
Good points there, Dean, but just keep in mind that if you want to look at it this way, paying taxes can be a good thing. It means that you made money over time. So always keep that in mind. And you want to be very careful making investment decisions based solely on taxes, because if you make those investment decisions based on taxes, that can be hindered, which that's the last thing that we want. So it's all about taking the whole scenario into consideration, where we want to look at the big picture. We want to look at your investments, taxes, retirement income planning, everything as a whole, and then make those decisions. So again, taxes is one of the very few things that that no matter what, we can't get around it. So again, be careful making investment decisions solely based on taxes, and in a way, taxes, it can be a good thing. It means that over time you probably made money on your investments.
Okay, good point. If you're just tuning in, I'm Dean Listle. I'm here with Tyler Listle. We're financial advisors with Secure Retirement Solutions. We're located on Allied Street in Green Bay. If there's anything here you'd like to talk to us about or have us give your portfolio a free review, we're located, again, Allied Street in Green Bay. You can call us at 920-347-9888. We can give you a complimentary review of your existing portfolio if you'd like, or you can go to our website to get a hold of us at srsplans.com. Okay, moving on to the next pitfall we see or hear in the office is watching the market too closely too often. I hear this one a lot. I see this one a lot. Tyler, what can you say about this?
Yeah, Dean, our sixth pitfall here, too much market watching. And this one may not come as a surprise to many people based on today's day and age that we're in right now with the news and the media. We're so news and media driven, and people tend to get too involved and overcomplicate things by watching their investments every single day and not keeping the long-term approach in mind. And that's where, again, we want to make sure that we look at your whole entire financial picture. We don't make any knee-jerk reactions to the market, which many people do when they watch the market every day and they're too involved. But again, we want to always keep the long-term approach in mind. And I'm not saying don't watch your money at all, because you do want to watch your money, but just don't over-obsess about watching it every day that the market is open. There's a difference between watching your money, keeping track of your money, knowing what you're invested in, and over-obsessing about it. And also, you want to be careful of watching too much in the news right now. And as I said, in today's day and age, we're very media-driven. And there's a lot of people that buy and sell in their portfolios based on what they hear in the media. And it's never a good idea to mix investing and entertainment. And we see CNBC, Fox Business, there's a bunch of different TV stations out there that are very media-driven and they can almost twist the narrative at times. So again, retirement should be instead where you enjoy your hobbies and you don't worry about the market daily. And some people do have watching the market as their hobby, but again, we don't want to over obsess about it. It can give you an ulcer, as we like to say. So, Dean, if you have anything to add on to that.
Yeah, we have a client, and Tyler's very aware of him. He comes in and he said, I just need a filter. Guys, where can I find a filter? I want to filter out all of the political jargon, and I just need to know economic information about the investments. Well, first of all, politics do play a part in the indices and our market, so we need to take that into consideration. But you also have to have somewhat of a filter to filter out some of the nonsense, though, too. I tell people to typically go to a third-party independent source. If you really want to find out about the investment, do some research, go to something like Morningstar and just dig into the investment. Sit down with your advisor and tell them you want to find out all of the basics in reviewing what goes into a portfolio and so on. And as Tyler said, you don't want to over-obsess. We had somebody that worked with us that wanted to have a review or a meeting every day. Okay, now I said had because there's no way we could work with an individual like that. I don't think anybody could. And what we recommend is, leave that up to us. We watch these things hourly, every day. The other thing is you have to be short-term aware, but we're still looking at long-term planning. And when you're watching the market, you as a consumer, as an investor, daily, hourly, you're really looking at more emotion that's making decision than long-term planning. So again, don't watch the market too much. Leave that up to the professionals. And if you self-manage your own account, be reasonable.
Exactly, Dean. And again, many professionals who make these investment moves within a client portfolio, they're not making knee-jerk reactions based on the market daily. They're looking out a number of months ahead of time based on what they think the economy is going to be, not individual knee-jerk reactions each and every single day. So again, like you mentioned, Dean, these professionals are looking out months in advance before they make a move.
Okay, if you're just tuning in, I'm Dean Listle. I'm here with Tyler Listle. We're financial advisors with Secure Retirement Solutions located on Allied Street in Green Bay. You can get a hold of us at 920-347-9888 or on our website at srsplans.com. We're talking about retirement pitfalls, some of the pitfalls that people fall into when they go into retirement. Next one we're going to talk about is not having a financial plan. This is a big one. Part of the reason is we do give complimentary financial plans to anybody who comes through the door. Part of the reason is we need to know your financial situation. We need to know your debt situation, your health history, longevity. What are your goals? Do you want money to be used for your own retirement or for beneficiaries? There are a lot of things that go into play. You need to know those things before you can make a proper recommendation on somebody's financial plan. So we look at financial planning. Also, we find out if somebody has a financial plan, they have their retirement roadmap in writing, chances are that they are going to stick with it much, much longer than if you don't have a financial plan in writing. Ty, what else do we see when it comes to a financial plan?
Yeah, Dean, and like you said, when people come in for their first meeting with us, we always have to give them a financial plan, and we say we need to catch up to where you're at. Right now, you as the client are ahead of us, and we need to gather information and then put together your plan before we can make any sort of recommendation, because we need to catch up to you. We need to figure out where you're at first. And so again, number 7, the 7th retirement pitfall we have here is not having a financial plan. And this is very interesting because there were a few surveys that were done that have some pretty crazy numbers here. And the Employee Benefit Research Institute recently conducted a study on retirement savings, and nearly 50% of people surveyed had less than $25,000 saved in retirement accounts. And of the people surveyed, 25% said they have less than $1,000 saved for retirement. And obviously that's not much at all when people want to sustain a retirement that can be 20, 30, 40 years. And these problems really can be solved first and foremost by sitting down with a financial advisor, a financial planner, and formulating a plan. That's the number one step right there. Even something as simple as creating a written budget so you can find where your money is going, which expenses can be cut, and how much you can afford to contribute to your retirement account. And many of these people who have less than $1,000 saved for retirement, they don't have an employer-sponsored plan through work. So they don't have a 401k accessible or a 403b or a 457 plan. So that's where they need to start a traditional IRA or a Roth IRA on their own. And many people, they don't even know how to open that account. So that's where those are the real people that could really use some help by sitting down with a financial advisor and just figuring out what their retirement roadmap would be. And also, many changes happen throughout retirement, so we want to make sure that your plan, your financial plan, is updated each year to reflect those changes. So, for example, maybe you sell your home and downsize, or you buy a car or pay off your mortgage and have extra cash flow coming in during retirement, or you have a forced retirement and you have to retire earlier than you had planned. So there's just many different scenarios to plan for, many things that can change in retirement. So you always want to keep your retirement plan up to date each and every single year.
Okay, good points, Ty. What we're going to do is we're just going to go back and review some of these things. There are other retirement pitfalls we'll talk about in an upcoming show, but the one that we hear and see most often is investing too conservatively. As Tyler said, people will lock down the majority of their investments into investment funds that don't give you a rate of return that are going to carry you for the next 20, 30, 40 years in your retirement. Secondly would be just the opposite, and that's investing too aggressively. We have people that panic a little bit when they start getting into their 50s. They think that they need to get more money into their retirement accounts. Unfortunately, what happens is they are too aggressive. They have no hedge against certain sectors that might go out of favor, so they become too aggressive. The third would be supporting your adult children. Again, we all love our kids, want to help them out the best we can. If you're going to be doing that, probably in your working years is better than if you're fully retired, because once you pull that money out of your retirement funds to help them out, chances are you're not going to replace it. And remember, you can't go to the bank and get a loan for retirement. Okay, Ty, do you want to take the next couple here?
Yep. The fourth retirement pitfall we have is being over-invested in your home. We see it all the time. We're heading into retirement. Clients try and invest too much in additions in their home, but they don't have the retirement funds to keep up with the home improvements. Number 5 we have here is worrying more about taxes than return on investment. As you touched on earlier, Dean, we see this quite a bit where people, they don't want to pay a little bit in taxes to make a move in their investments that will better position them over the length of their retirement, 20, 30, 40, 50 years. So that one, be very careful when making investment decisions based solely on taxes. Number 6 is too much market watching. Again, in today's day and age, we're very social media driven, driven by the news, and watching the market too much can give someone an ulcer, quite frankly. And it's just too much of a hassle. Don't want to over obsess about that. And lastly, our last retirement pitfall is not having a financial plan. When we don't have a financial plan, we can't plan for the future. We don't know where you're at. You're not going to know where you're at. So number 7 is not having a financial plan. You want to get a financial plan in place, especially heading into retirement. Okay, folks, that's it for financial or retirement pitfalls. That's all the time we have for this week. See you later, and hope you'll join us again next week. See you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.